Welcome back. We're going to today talk a little bit about valuation and pricing of structured annuities. Structured annuities obviously provide an interesting new perspective and dimension to the whole annuity process. And for that, we are going to dive into details with an expert in the field. And Jan, could I ask you to introduce yourself?
Yeah, absolutely. So my name is Jan Rosenzweig. So I've been working in this field kind of on and off for close to 20 years now. So I started in 2005 at Credit Suisse as a quant. I've worked in a handful of places since then. So apart from quant, I was also a structurer, a trader, a portfolio manager. So I've kind of seen the market from, pretty much every angle. Um, and yeah, I've been kind of in the structured note space and structured annuity space more recently. So yeah.
Great. We're lucky to have all that sort of experience and perspective in this discussion. So we'll dive really quickly into the topic, if you will. So, to start off with, Jan, if you could give us a little perspective on the structured notes, variable annuities, structured annuities ecosystem, if you will, and give a little perspective on the context and what
Yeah,
they
of
are, why they
course.
are challenging to value and price, and so forth.
Of course. So I mean, the basic idea is obviously, I mean, we've had booming equity markets for, a good number of years now. So the basic idea is to offer investors exposure to that. So the investors get to participate in the upside from the markets, but they do get some level of downside protection for that. And this was kind of the same idea that happened, with the structured notes originally, whenever that market was active. So this now, close to 15, 20 years ago. So on the structured note side, this did get kind of taken a bit too far in the risk-taking directions, and we saw proliferation of, fairly exotic structures with fairly non-transparent risk exposures. So far, we haven't quite seen that on the structured annuity side. So the market seems to be fairly disciplined, fairly kind of well maintained. I mean, obviously, whenever you start talking about downside protection, upside participation, you're always going to be having some sort of market exposure that's not necessarily transparent to the end investor, because these protections and these participations do come from somewhere, and these things have a price, and just the fact that you don't necessarily know what that price is and you don't see it doesn't mean it isn't there, and it doesn't mean it's not a risk source that you're exposed to. However, it's still, the market is still pretty disciplined in that respect, and we don't see kind of big proliferation of kind of exotic structured risks. Another kind of benefit of the structured annuity structures is the tax treatment. So, you get kind of deferred tax treatment, which is quite helpful, especially for the end investor who's typically not holding the structured annuity through any kind of tax efficient structure. So the deferred tax treatment is I guess a big draw as well.
And do you think the relative discipline in the kind of issuances and the kind of structures out there, is that something due to experience? What has been seen in the structured notes market, so people don't want to repeat mistakes, or do you think it's just it's the nature of annuities and annuity structures that make the different nature of the issuers, if you will?
I mean, if I'm perfectly honest, I think um, we haven't quite reached that stage yet. I mean, this is typically, when we saw that previously in the structured notes, it was always client driven. So, this was a competitive market. The clients were always pushing for a bit more yield, a bit more upside, a bit more participation. And, they weren't necessarily all that concerned with where that would come from. And if you try to be too disciplined, you would just get outbid by somebody who was, a little bit more daring than you, and you just end up not getting the business. So, in a way, the market was self-selecting for that sort of thing. So I'm going to go out on a limb and say that, with structured annuities, we've simply just not reached that stage yet, as in the market is just not sufficiently competitive just yet. So, it's kind of easier to keep the discipline. But if it continues growing, I'm it would not surprise me if we saw similar sorts of competitive pressures. And I'm not going to say similar results, because obviously, yes, obviously lessons have been learned and safeguards have been put in place. But yeah, certainly when it comes to that kind of aggressive push for extra yield, it has to come from somewhere, right? You can't just, dream it up. I mean, it will come from somewhere, and I cannot anticipate where it will come from. But yeah, I do think we will get to that point with structured annuities as well.
It's an interesting perspective. The lack of maturity or the lack of immaturity, whichever way you want to think about it. So, sort of switching sides a little bit, looking at it from the issuers and what are the valuation and hedging challenges do you see in these products?
I mean, there aren't any significant valuation hedging challenges because, like I said, I mean, these are not very exotic products. I guess on the valuation side, there's obviously, always going to be a gap between the market price, which is the kind of hedging price, which is what the dealers and the issuers are exposed to. And on the other side, you've got the investors who are not actually hedging them. So, they just accept the dealer valuation because that's the kind of secondary market at which they could redeem the annuity. But in a way, the kind of, let's say, the risk neutral pricing would not even be applicable to the end investor because, that is applicable to whoever is hedging it, and the end investor is not hedging their position. And therefore, the whole concept of risk neutral valuation would not apply. So I guess, it's more a conceptual sort of thing. And this kind of comes back to the structuring side because you're always kind of offering this gap between where you see a value as a dealer, which is in essence, what kind of inventory can you get relatively cheaply? And then where do you see the value as the investor, which is which of this inventory, when kind of left unhedged, appears to kind of provide most bang for the buck. So it's always kind of that sort of gap, and that's obviously by definition it's fluid, right? Because if once you get the idea that yes, this inventory can be turned into something that investors value, obviously people will snap up that inventory. It will no longer be cheap, and that won't work anymore. And then you'll have to move on to whatever else is cheap now, and how you can turn that into something that's provides whatever the investor needs.
And in some ways, do you see how do you see the dynamics of how do you see the dynamics of the interest rate environment? Given that the interest rate environment is higher now, and at least for the foreseeable future looks lot more volatile. Do you see that as having a significant impact?
Well, of course it does, right? Because in essence, that's the whole annuities trade, and the structured annuity is, the investor is swapping the high interest rate for the equity participation. So in a way, yes, obviously, when the interest rates were close to zero, there wasn't much interest rate, and it wasn't possible to get any equity participation for that. So I would say yes. I mean, the high interest rates are obviously not just having an impact, but I mean, literally, if we didn't have higher interest rates, there wouldn't be an annuities market to speak of, right? When interest rates are zero, there's, why would you buy an annuity? I mean, you would just sit on cash, right? I guess the downside of that is that the inflation is higher as well. So it's, in essence, you need to do something, otherwise your capital just erodes with inflation. So that's, I guess, a sort of driving pressure apart from the, let's say, the pull from the kind of high performance of the equities market. On the other hand, you have the push from the high inflation, which is kind of saying, well, it's not just you want this participation, you actually need it. Otherwise, your investments are getting eroded. Volatility of interest rates, I'm going to say, doesn't necessarily enter into the picture. I mean, it would if we were looking at, seriously long-dated structure, something like, 10, 20 years. This is where kind of volatility of interest rates comes into play. That's I've not seen any kind of structured annuity structures, going into that sort of length. I'm not saying there aren't any. I mean, I don't see the entire market, but certainly it's a kind of niche corner. So I don't see the volatility of interest rates having much impact, but certainly the level does.
And and how do you think about the computational environments for pricing and hedging these products? I mean, and do you see the requirement for special purpose tools? What role do you see with, say, grids and the cloud, for example, enabling some of the institutions to build and scale their platforms, if you will?
Um, so I mean, obviously these tools progress all the time, and we've had quite a few things which we thought of as revolutions in the field, such as, let's say, use of GPUs for simulation and use of adjoint differentiation for like hedge ratios and stuff like that. And this was now 10 years ago, 20 years ago, when these were kind of new and promising technologies. Now they've reached a certain level of maturity. They've been incorporated into the ecosystem. They've certainly had an impact. However, none of them is a magic wand. I mean, each of these comes with some sort of overhead, and sometimes the overhead is just basically too much, and it turns out that actually, no, you would have been far better off with maybe a simpler method. The additional issue is obviously the choice, because, for any structure, there's always going to be one simple model which is specific to that structure and does that structure really well, but can't do anything else. And on the other hand, you've got a general model which can do everything, but then, needs to have some extra complexity in that. And then as a dealer who's kind of managing inventory, you need to make some choices. I mean, are you going to, in essence, end up pricing every single product with its own specific model, or will you just have one overarching model for the entire book? And it's not a straightforward choice. I mean, I have personally always opted for kind of, having one consistent model across the entire book, and then, maybe having a bit of unnecessary complexity. But at least you made sure that, all the products inside the book were priced consistently, and, you weren't introducing artificial bias. However, I don't claim that this is some pinnacle of wisdom, right? And there are perfectly good arguments for the exact opposite approach. So I guess, ultimately it's just a choice. Um, in terms of, the cloud and grid computing, I mean, that's obviously democratized things to a great extent. I mean, the kind of, let's say, the barrier to entry for an issuer is now quite a bit lower, because, you don't need to buy computing power. You can just rent it from the cloud. And yes, you can get that fairly efficiently. To be perfectly honest, the barriers to entry on some other sides, such as regulatory and compliance side, have gone up. So that possibly nets off. So I'm not going to say we are in a necessarily better position as a kind of new aspiring issuer. I'm just going to say it's a different position. I don't think you're necessarily in a worse position. But yeah, certainly I think on the technology side, it has matured quite a bit, and it's been maturing for, gosh, close to like 50, 60 years now. I mean, it's that um, technology has been kind of coming along since at least 1960s. So it's gone through quite a few generations now. Um, I guess the next question is where it goes next, and that's always difficult to anticipate. To be honest, I don't necessarily see that we've got that much scope for any kind of big dramatic changes. I think we've kind of made most of the efficiencies that you could see. I think we've kind of pretty much already incorporated them. So I think if there's any kind of big leaps, they'll probably come from somewhere pretty unexpected, something that we can't even see at the moment.
So, do you think in some ways it's really adopting technologies that are already sort of out there, in the sense in moving some of your compute to the GPUs, ensuring that you have AAD for your hedging programs, integrating the integrating the environments to have relatively flexible structuring tools. And so sort of it's more moving and tackling and pushing and sort of those kinds of things rather than revolutionary sort of moves, if you will, from a technology standpoint, in your perspective.
Absolutely. I mean, I think, we've got basically a whole bunch of tools out there. I mean, some of them are even open source. So, if you wanted to set yourself up, to be honest, you could just kind of download a bunch of software off the internet and, spend a couple of days setting it all up and, you'd be good to go on one hand. On the other hand, there's still room for kind of, fairly complex in-house development. It's still, reasonably competitive, and there's still, um, you know, you do get different firms developing edge in kind of different corners of the market. So, that there's still quite a bit of value from having your own kind of proprietary technology, your own proprietary know-how. That I don't think has gone away, even though, like I said before, the market isn't quite as competitive as, it might become in the future. Still, you can still see that sort of competition. You can see that driving innovation in kind of, different corners of the market.
Thank you. So that's all we have time for today. But I think that sort of summarizes the sort of universe, if you will, a relatively mature market with which has moved through its stages of maturity and growth, but has some really interesting niches that individual firms need to tackle, and a relatively mature technology that needs to be sort of potentially spread through the universe and ecosystem, if you will. So thank you, Jan, and thank you sort of for illuminating and illustrating the structured annuity space, if you will.
Thank you very much.